Types of free cash flows for the purpose of business valuation. So the cash flow can be a free cash flow to firm, FCFF. And how do we find out the free cash flow for firm? So you start with the net income, plus you add the NCC, which is non-cash expenses, and then take interest, net it off the tax. So take interest and 1 minus tax rate, plus increase decrease in net working capital, excluding surplus cash minus the capex. So this will give you your free cash flow to firm. All right, FCFF. Now, what you need to understand here is very clear. What is the meaning of FCFF? The meaning of FCFF is free cash flow, which is available for the business for the benefit of all the stakeholders. So that is your FCFF. That is your FCFF. Okay. Right, so that's number one, and then what you need to do, you need to find out the FCFE. So FCFE would mean free cash flow which is available for the benefit of equity holders, right? That is FCFE. How do you find out? You will find out the FCFE by starting with the net income and plus your non-cash expenses, plus minus increase or decrease in the net working capital, excluding the surplus cash. And why do we have to exclude the surplus cash? We will understand. Minus the capex, plus fresh borrowing, minus repayments, and minus fresh dividend. So this formula will give you your cash which is available, free cash which is available for the benefit of equity holders. So this is known as your FCFE. Now remember, you should not memorize this formula, because it will be next to impossible for you to memorize this formula, because when you are sitting in front of the computer and writing your exam, it is quite possible that you will get confused about something or the other. Understand the principle behind it. And what is the principle behind it? The principle behind it is that FCFF means what? Cash which is available, free cash which is available for the benefit of all the stakeholders of that business. That is your FCFF. So what is available? What is available for all the stakeholders? So you have net income plus non-cash expenses. So what are the non-cash expenses? Your depreciation and amortization are your non-cash expenses. Then you take interest, net it off by the tax amount, which is also available for the benefit of lenders, plus minus increase in the net working capital. So in case if your working capital has gone down, that means so much of money has become available for the stakeholders. If your working capital has increased, that means so much of money has been consumed in the working capital and it is not available. So increase or decrease. Likewise, capex. So in case if you have done any capex, that means so much of money is not available. Likewise, if you have sold an asset and by selling the asset you got some cash, that means you add the sale of the asset to the formula of FCFF.
Sir.
Yep.
Sir, here this increase in decrease in net working capital is there. Sir, that alone I have one doubt, sir. Working capital is net working capital is current assets minus current liabilities.
Right. Yes.
That in case of current assets is suppose 6, current liabilities 4, means remaining 2 is there.
Correct. That's net working capital.
Yes, sir. But that is not the cash, no, sir. Whether we can add it, sir. Yes, sir.
Okay, good. So, you know how it is, Sukumar? Last year, your net working capital was 10.
Yes, sir.
This year, your net working capital is 6.
Yes, sir.
That means your net working capital has reduced by 4.
Yes, sir.
That means 4 rupees is available to you as cash.
Okay, sir.
Do you understand what I'm trying to say?
Okay, sir. It is comparison between years.
Yeah. So let's say your inventory was 100 rupees last
Okay,
year. Your inventory this year has gone down to 40 rupees.
Okay, sir.
That means 60 rupees of cash has come into your kitty
Yes, sir.
because
Yes,
of change
yes,
in
sir.
the working capital.
Okay, sir. Okay, sir.
So
Okay,
that is
okay,
what it is actually.
Okay, sir.
That is what it is. Okay. So that's your free cash flow for equity. And how do we find out free cash flow? Sorry, that is your free cash flow for the firm. How do we find out free cash flow for equity? This is how we will do. So you start with the net income, because net income is available to all the shareholders.
Yes, sir.
Add the NCC, non-cash expense, because depreciation and amortization, even though they are debited to P&L, but the money does not go out of the business, so that money is also available. So you add the NCC.
Yes,
You adjust the change in the working capital as you did in case of FCFF on the same principle. Excluding surplus cash, and that we will discuss little later, minus the capex, because if the capex has been incurred, that means so much of cash has gone into the capex, that money is not available.
Yes.
Plus fresh borrowing, so some money loan has come, added
Yes, sir.
to the FCFE, and if you have repaid some loan, minus the FCFE, and if you have a preference share capital, minus the dividend on the preference share capital also, because that money is not available for the benefit of the equity holders. So this is how you will find out your FCFE. So this is very
So
crucial.
this fresh borrowing, we have to minus it. I mean, we have to
Add it.
add it.
Yeah.
Here,
Why?
We are trying to find out for the equity now, sir. That the debt has to be reduced now, sir.
Yeah.
Why we are adding it, sir?
Right. See, the debt
Yes, sir.
that you are getting into the business,
Yes, sir.
by the amount of debt,
Yes, sir.
the cash available in the business is increasing,
Yes, sir.
right? And the cash available in the business is increasing,
Yes, sir.
and that cash is going to earn
Yes, sir.
a return.
Yes, sir.
Out of that return, a part of it will be paid for the interest,
Yes, sir.
right? And
Yes, sir.
the remaining is going to be available for the
Yes, sir.
benefit of the equity holders,
Okay, sir.
isn't it? And remember, you have taken the net income.
Okay, sir.
Net income figure is arrived after deducting the interest.
Interesting. Yes, sir.
So the fresh borrowing which you have taken,
Yes,
the effect in the valuation
Yes, sir.
will be accounted, which is net of the interest.
Okay, sir.
Okay. Now here I would like to tell you,
Yes,
that you must remember, you are using discounted cash flow method,
Yes, sir.
and in discounted cash flow method, whether you are using FCFF
Yes, sir.
or FCFE, what you have to take into account? You have to take into account the cash which is going to be available.
Okay, sir.
Cash which is going to be available,
Available.
from where it is coming, irrespective of that actually.
Okay, sir.
Because ultimately, you are using discounted cash flow. That means you are trying to find value of a business based on the cash which is available.
Okay, sir.
So this year it is available. So
Yes, sir.
you take it as part of your FCFE. Next year it is repaid. So
Yes, sir.
next year you minus it. So because next year you will not have the benefit of that cash.
sir. Yes,
So
sir.
you
Yes,
reduce
yes.
it actually. So this
Yes,
is the
sir. Yes.
this is the principle behind making the FCFF calculations and FCFE
Yes,
calculations.
Sir, regarding this net working capital, as you said that we have to compare the period or last year period, and accordingly we have to increase or decreasing this. We have to do it at point. But in this free cash flow itself, we are projecting for the next 5 years. Like that we are doing, sir.
Right.
For current year information alone, we are from zero onwards. We are starting this one.
Right.
Assuming the growth rate, the cost of capital, everything. This net working capital comparing the last year and this year, whether how it is, we have to do it, sir. Because
Good. I will tell you. Let's say you are in the 0 year.
Yes, sir.
So whatever is your net working capital,
Yes, sir.
it is addition to your net working capital. So you will need to minus it.
Yes, sir.
Are you with me?
Yes, sir. I have to minus it.
Correct. So in the current year, the 0 year, first year,
Yes.
not 0
Yes,
year,
sir.
first year.
Yes, sir.
So
Yes,
first year, whatever you are investing in your net working capital,
Yes, sir.
that is outflow
Yes,
of
sir.
cash. So it will need to be minused.
Yes, sir.
In the second year,
Yes, sir.
whatever is your net working capital,
Yes, sir.
if it has increased,
Yes, sir.
then whatever is the amount of increase
Yes, sir.
in the second year,
Yes, sir.
that you will need to minus.
Yes, sir.
And in case if it has decreased,
Yes, sir.
that means so much of cash is available to you.
Yes, sir.
So you will need to plus in your cash flow calculations.
Okay, sir. Okay, sir.
And likewise you do for the entire period,
Okay.
for the entire projected period actually.
Understood, sir.
So if it is increasing, you keep on minusing it. If it is decreasing, you keep on adding it
I'm
actually.
adding.
Because so much of cash is going to be either consumed
Okay,
or
sir.
available actually.
Yes, sir.
So this is how your FCFF and FCFE calculations
So we have
will
to
need to be
project
done.
this working capital also for the next 5 years.
Of course, because when you are making the projected cash flow,
Yes.
projected earnings, projected
Yes,
earnings or projected cash flow will have
Yes,
to be comprehensive. So you will need to project your P&L, you will need to project your balance sheet, you will need to project your working capital, you will need to project your cash flow, you will need to project your interest computations, you will need to project your depreciation, you will need to project your, everything actually.
Okay, sir.
So that will have to be done very comprehensively. Yep. Okay.